Okay, so what kind of things are you learning right now in your Monday night class? Oh, God. What did we do? So what are you learning right now? What are some things where you
the
going?
secondary market.
Okay.
Fannie Mae.
Okay. Why do we have a secondary mortgage market? What's it do? What's its purpose? Resells our mortgages. Okay, if a bank loaned you money and they just loaned money and never resold the mortgages, they'd run out.
Right.
So they have to have a secondary market to be able to bundle up, sell the mortgages so that banks can keep lending. That's the whole purpose of the secondary market. But what it does is it gets the secondary market investors, stockholders, anybody else can come in now and be part of this real estate game to do it. But what Fannie, Freddie, and other organizations are doing is they standardize the process. If you want to do Fannie, Freddie, you're going to use their forms. You're following their guidelines. And they're the ones that are saying this is how we're going to bundle our mortgages and resell them on the secondary market. Well, boy, what you just did in 3 hours, we did in 5 seconds. Okay, anything else? What else are you learning? Oh, you guys are so involved in this. Here, okay, so we'll talk about it though. We're going to talk about appraisal valuation. You guys really haven't gone into the appraisal yet. And when you start getting in the appraisal group of stuff, let me know. I'll help you out with it. I actually have an appraisal that I have that my son did on his house a couple years ago to show you a filled out completed form that'll give you examples if it's not in your textbook. Now this textbook actually has a good form in it, the appraisal document, the basic appraisal. I think I saw it here somewhere. We've got a promissory note in here, which is good. Yes. On page 213 through 215, through 217 actually, 18, is the whole appraisal report. It's a blank report. So if you guys get to a point where you need an actual completed report, let me know, and I can get one. I can help you out with that. So we're talking about different appraisal valuation. We're going to talk about professional qualifications of an appraiser. One of my jobs for a while, I thought I would become an appraiser. And I went to work for a low base salary, but I went to work for a company that would pay for me to get educated. I would have had to do 3,000 hours under somebody, which is almost 3 years worth of work, and take a bunch of real estate courses that are specific appraisal courses. So the deal for me going to work for this company is I would get my apprenticeship under somebody, but they would also pay for me to take all the courses. And that was kind of the trade-off for me for working low. And the goal was by the time I was in mid-50s, I'd become a certified appraiser, and I'd have a broker's license. I'm a lead AP. I would try to specialize in appraising green buildings. Kind of what I thought I'd want to do.
Sounds like a decent plan.
Yeah, it was a decent plan. The company went out of business, and I got let go. And nobody else, it's hard to, the best time to become an appraiser is when you're young, because they don't want to pay people a lot of money to learn for 3 years to go through that process. So it's a low salary type job, but it's a great learning experience. So again, it's a great time to, if you want to do it. Differences between security interests, mortgage, and deeds of trust. So we're going to, the first part of this chapter, appraisal, quick. Then we're going to talk about the terms of the notes and mortgages. We're going to differentiate between types of mortgages, difference between taking subject to and assuming mortgages, and then some federal lending laws. So again, what you guys are covering in the full semester, we're going to do here tonight in an hour or less. Okay, so property appraisals. It's basically to appraise real estate means to estimate its current value. So the people that estimate value, they're trained. They have to go through rigorous training. They have to apprentice and learn the program, take an exam, and become proficient in what they're doing. And they follow something called a USPAP, which is Uniform Standard of Professional Appraisal Practices. So there's this whole appraisers organization that puts all the rules together about how we appraise. And yes, you can appraise from state to state. Each law has its own rules about taking and doing the work, but it's like selling real estate. It's very similar from state to state, but there are specific laws. There are 4 elements that affect the value of real estate. Utility. how can we use our piece of real estate? Utility. Scarcity. Guess what? Real estate is scarce. And if you want to get a piece of property that's on a shoreline, it's becoming even more scarce because we're losing our shorelines. Demand. How much demand is there to buy real estate? That's a big factor that affects the value of real estate. And transferability. How easy is it to sell, to make that change of real estate? Those are all things that affect the value. So the appraisal valuation methods that we have, the forms that you see, the residential form that we primarily use, most of its basis is called market or sales comparison approach. We're out in the market and we're trying to find other houses, other pieces of real estate that are similar, and we make adjustments to those pieces of real estate for the differences. When a realtor comes to take a listing on your house, they're going to do a CMA, competitive market analysis. It's a hybrid short form of an appraisal. They're basically going to say, this is what's available on the marketplace, this is what these houses are selling for, this is how these houses are like yours, and this is how we're going to make adjustments to your asking price based on what these other asking prices are. But a CMA is based on some sales and some ask price. Appraisals can only be based on the actual sale of real estate. They can't be based on something that's for sale. But a CMA looks at for sales.
Can you use foreclosures as a comp too, or no?
They use foreclosures. It bugs the heck out of me, but they use foreclosures. And it's bad. And they have to because of the marketplace and where it went. And to me, foreclosures are distressed properties. But the foreclosure is the last place to go to. When you're trying to sell a property that doesn't have a lot of comps in the marketplace, hasn't had a lot of sales to go to, you're going to use foreclosures. Today we have enough activity, they don't have to go to foreclosures. But it does drive the value down. Overall, foreclosures are driving the market value down still. They still do that. So the market sales comparison approach, we compare the selling price of similar properties. We make adjustments for the differences among them. The cost approach estimates the value of a completed project or the cost of building of a comparable project. Cost approach is something we will look at for residential. What does it cost to build that house? But we also look at depreciation when we look at cost approach. If a house is brand new, we're going to pay close to what it costs to build it. If a house is 10 or 15 years old or 30 or 40 or 60 years old, there's depreciation. It's not up to today's standards. So we're going to modify it to bring it up to today's standards for wiring, for plumbing, for the basic pieces of the house. So that's adjustments to be thought about.
I recently had an appraisal done, and it was the market sales comparison approach, and the appraisal shows a property that was 33% smaller than mine. I kind of questioned that. I didn't know what constitutes a similar property.
33% smaller is fine as long as they gave that property more value to make it similar to your. They gave it more value, so they made it a higher value than what it sold.
My property more.
You only adjust the comps. The comps get marked up or down based on how they are. That property should have more value. No. If it's 30, your house is 33% smaller, or the property.
Larger. My property is larger.
Your larger is, yes. So that house had to have an adjustment value added to it to make it come up to your value. They would have had to add value to it to make it come up to the value. And yes, you can use properties that are smaller. You can use properties that are farther away. You can use, as long as you make adjustments to reflect that on those comparables. We only adjust the comparable properties. We never adjust the subject. The whole idea behind looking at these comparable properties and making plus and minus adjustments to them is we're getting values to them that say, okay, now this house is close to what my subject is, therefore that's the value of my subject property.
But how do they do that without going into the other houses?
They call, they ask, they do a lot. And
sold houses.
Appraisers have been around more than you know. And they have good data banks of stuff. And they share information, but they call realtors. So when I was doing commercial appraisal, that's what I was studying to do. We would call brokers, or we would call salespeople, or principals that were involved in the sale transaction to find out details. Try to get some pictures. Try to see things to help us get to a value.
today we just got a phone call from a realtor because we purchased on the street fairly, 2 months ago. So they're asking why the difference in the asking price was so much different than what we actually bought it for, and they wanted to know. And then our realtor got a little upset because this other realtor is contacting us, which was a whole different scenario.
But you bought it a few months ago. They had every right to call you, to reach out to you. They wanted to get the true scoop.
Kind of an attitude.
Yeah, but that's where realtors are trying to say, my property. Because you know what? The next time you go to buy or sell, that realtor still wants you to use them. Huh?
We're dying in this house. So
Yeah.
Sorry. Yeah.
So, but that's what's going on with that. So, again, then the income approach is value based on property's ability to generate income. Residential real estate doesn't generate income unless we're buying it to do that. So that's the one approach we typically don't put a lot of thought in. But we use the income approach for all income properties, for an office building, for industrial building, a retail building. It's a full piece of that appraisal report. And we go to great lengths to create the reports, the income and expense reports, to track them for 5 years of costs and expenses to get to the income approach. It's a long, involved process. Licensing and certification. Congress passed Financial Institution Reform, Recovery, and Enforcement Act, FIREA. So all of our appraisers are licensed and certified to be able to hang their shingle to say that they're appraisers, because that appraiser has great influence on how we're going to finance our house, how we're going to buy our house, and ultimately what the deal is going to be. Like I said, my son made an offer on the house. They were asking $120, he offered $115, and it came in at $110. The bank was not going to let him finance it at $115. So they marked the house down to $110, and he bought the house for $110. Again, but that appraiser, huge influence on that whole piece. Appraisal licensing categories. We have trainee appraisers. All they're allowed to do is collect data. They're not allowed to actually make the written report. We have licensed residential appraisers. We have certified residential appraisers. And we have certified general appraisers. So your takeaway from all of this is there's licensing categories, there's a skill, there's coursework, there's tests that you have to do to get to these different levels. If any of you are all interested in learning more about becoming an appraiser, go to the Ohio Division of Real Estate website, and you'll be able to learn more about it as well. Anything you take on in the course book, but also on the ODR site, you'll see more about it. Okay, appraisers have liability. Any appraiser who negligently values a property may be liable to those who suffer damages relying on that. So they have something called E&O insurance. Appraisers designated by lender to value borrower's property owed a duty of care to the lender and not to the borrower. But here's the wonderful thing about this. When an appraiser gets an appraisal assignment, they know what the offer is. They're not going in blind. They've been given paperwork by the bank to go, look at this house. There's an offer here of this. What they're trying to do is validate that offer. That's really what they're doing, is validating that offer. In my son's case, they didn't validate. They came back with their own value. But it was a completed appraisal report. Once he got negotiated to where he should be, he was still able to use that report to buy it. Okay, so wow, we just went through what you're going to do in those weeks quickly, very quickly. As I said, this is a very quick summary of what you're doing. Mortgages. We take for granted in the United States something called a mortgage. We expect fully that we have something called mortgages, that we're going to be able to use a mortgage to buy real estate. In other countries, mortgages is not always available. People in other countries, it's families, generations of families that own real estate because they don't have something called a mortgage. Or generations have to come together to buy the real estate. Mortgage secures a promissory note. It's a two-party instrument financing arrangement by which one person, the seller or the purchaser, borrows money. And then the promissory note is a borrower's promise to repay the money borrowed. So when you go to a closing transaction, you're going to sign a mortgage and you're also going to sign a promissory note. There's two pieces that you sign. And the promissory note says that I'm going to repay the mortgage And if I don't repay the mortgage, then you can claim my house. You can come back and take it. So that's what that promissory note's doing. That's called foreclosure when it happens. But that's we're letting them happen. We're voluntarily letting it happen from the very get-go. We're letting it happen. Mortgage process. There's a loan application. There's processing and document gathering. There's underwriting. There's approval or denial. And then ultimately there's sale in the secondary market. Again, this is that Fannie, Freddie, Ginnie. All of their policies and how we underwrite loans and what we do allows them to bundle those mortgages to be sold on the secondary market. But they have their own little rules and policies of how it's all done. They're not a lot different, except that one of them primarily is farming properties, and some of them deal with FHA and different things like that. So, but if you're curious about this whole mortgage loan process, you can go online and try to apply for a mortgage. It's really easy. It's an easy way to get done today. You can hear back in a matter of hours what you qualify for, or even online right away. But one of the things you're going to do as a realtor, when you're trying to help people buy a house, you're going to have a whole list of the documentation they need to do a mortgage application. Because they need to, if you're going to sit down at a computer and do it, it's going to take a little bit of time, but there's a bunch of stuff you need to have with you to be ready to do it. So that's part of this realtor toolkit, is being able to say to people, these are all the documents that are going to be required if you try to go online or go to a bank to apply for a mortgage. This is what they're going to want to see. Ownership of mortgage property. The mortgage is either conveyance of a legal interest to the lender or a lien to secure the repayment of the debt. Ohio is a lien theory state. It's used in a majority of states, providing the mortgage does not transfer legal title to the lender. Instead, the lender has a lien on the property to secure repayment of the debt. So Ohio is a lien state. Title theory is used in a minority of states, provides that a mortgage is a transfer of title to the property to the lender for security purposes. They actually have little different lingo that they use in the title theory state when they're doing mortgages and how you pass a deed and what you do. But Ohio is a lien theory state. There's a promissory note, executed instrument, acknowledged a debt, promising to pay the creditor. The debtor, person who executes a note or contract, is primarily liable for the repayment. That's you, the home buyer, is the debtor. The payee is the mortgagee, the person who receives payment under a note or negotiable instrument. The E's and the OR's, this is where they get flipped around when you're having to remember the vocabulary. Or whenever you're buying, you are the or, the buyer. And the payee, the E, is the owner of the mortgage or the bank. Okay, terms on a promissory note. Okay, this is also a contract. It's going to tell us the loan amount. It's going to tell us the maturity date. It's going to have an interest rate. It's going to have prepayment penalties. In Ohio, we do not allow prepayment penalties on residential loans. That's consumerism at its best, but we do allow it on commercial loans. There is no such thing as a prepayment penalty on a residential loan. So that's one thing to remember for your test. Late fee clause. What is a late fee? When's it happen? Acceleration clause. Okay, if you don't pay the mortgage, they accelerate, they foreclose, all the money's due at once. That's what acceleration does. It brings all the money due. Now, it's not all the money due at the end of the contract if you held it for 30 years and paid 30 years worth of interest. It's all the money due today at the time you've defaulted to settle the loan. The due on sale clause. We used to have mortgage assignments. You could assign your mortgage and sell your mortgage. And that happened when interest rates are 12 and 13%. Somebody had a 5 or an 8% mortgage, they would assign their mortgage. Today, mortgage companies don't allow mortgage assignments. They have something called a due on sale clause that says the moment the house sells, you got to pay the mortgage off. That's the first thing that has to happen. You can do some assignments of mortgages. It's rare. It happens, but for the most part, due on sale says it's not going to happen. We're not going to allow assignment. We want, as soon as the house sells, it's got to be done or we're paying that mortgage off. Generally, the mortgage includes following terms: identification of the parties, property description. Again, legal description, the address is fine. It doesn't have to be full legal description. Terms and conditions. Mortgages often include all the same provisions found in the promissory note. And then the assignment of rents clause entitles the lender to any rents or profits generated from the property in the event of default. So my leases also have provisions in them, commercial leases, that say that the lease payment may be assigned to a mortgage holder. It subordinates. The same piece of real property can be used as collateral for more than one loan. How is that? How is it that one property can be used as collateral for more than one loan?
It could be worth a lot, and there could be a couple loans that aren't worth as much as that one property.
Or you've owned the house for many years and you've paid a substantial amount on it, so you don't owe that much on it anymore. So now we can borrow more against what we owe or what the house is worth. That's what we call equity, guys. That's the whole reason for the whole real estate game, is equity. You're trying to own more of the house than the bank owns, so you can do things with that. And for years I didn't hear things about HELOC loans. Now I'm starting to see more commercials about HELOC loans, home improvement loans. Mortgage your house to the full value of the house. You can borrow money to make improvements. You can borrow money to buy your car. You can borrow money to send your kids to school. You can borrow money for all kinds of things using your house as collateral and not have to pay as high of an interest rate as you would if you used a credit card. So that's what a HELOC loan does. It doesn't say you have to put money into the house. You're just borrowing against the equity of the house. Second mortgage is a mortgage recorded next in time. So we can do, again, more than one mortgage can be a second mortgage. That means the second mortgage holder stands in line. If there's a default on the property, the first mortgage holder gets paid, then the second mortgage holder is out there waiting for whatever's left over. Purchase money mortgage. Mortgage financing the purchase of a 1 to 4 unit residential property may be for a partial or full purchase amount. You're not going to see something called a purchase money mortgage a lot. Typically when we buy a 1 to 4 family, we're just doing traditional mortgage. We don't use the purchase money mortgage. You don't see it a lot in our market in Cincinnati. That verbiage of what it is. Conforming versus non-conforming loans. Okay, conforming loans meet Fannie, Freddie, Mac purchase criteria in the secondary market. They're written, they're underwritten, they're appraised, all the paperwork, everything's used to create those Fannie and Freddie Mac loans is all their paperwork. So they conform to their requirements. Non-conforming loans are loans that fail to meet Fannie or Freddie Mac purchase criteria in the secondary market. And banks don't have to write conforming loans if they don't want to sell them. My loan is through U.S. Bank, and they've never sold my loan. I wish they would have. But they never sold my loan. For some reason, they held on my loan. And banks can make a choice to do that. But for the most part, most of their loans are available for sale because they got to keep selling them to be able to keep lending.
Why would you care?
I don't care. Oh, why do I
You
care?
just said you cared.
No, I care because dealing with U.S. Bank is a pain in the ass.
Customer service.
Customer service, yeah. Because, I don't like the customer service. I've had some issues with my mortgage, and the left and the right hand don't understand what they're doing. They're as good as dealing with a VA or something when you're trying to get answers.
Did they notify you when it goes into this?
They do.
Get sold?
Yes,
They did?
yes, they will. I've been to closings literally on a refinance when I lived in my house for years, but I refinanced it. I've gone to refinancing literally to sign right there that it's going to be sold.
When I built my house, they did that to me.
Yeah. Yeah, that's not a problem. And again, you don't care because you're paying the mortgage was created, the promissory note's there. That's what they're buying. So it doesn't change your
Yeah, the terms exactly.
terms don't change anything. It's customer service. Yeah, I just couldn't get through the lunkheads what I was trying to get done. Government-sponsored mortgage programs. We have FHA insured mortgage loans. Mortgage lender does not make loans, but they insure the loans. And to qualify for FHA, there's certain kind of income restrictions, requirements, and everything to fall into the FHA. More middle income people qualify for FHA than you realize. A lot of people, it's a broader band than you realize to qualify for an FHA loan. But FHA loan means that the house has got to be inspected. There's more things that have to be done. A lot of people just don't want all the red tape, so they don't want to do it. A VA guaranteed mortgage loan. You better be a vet. It's Department of VA, provides benefits for veterans, members of the National Guard. I have my security guard, my primary security guard. He was a member of the Ohio Guard. And the Ohio Guard is not the National Guard. And he went in very recently, he became a member of the National Guard. So he's away at boot camp right now for 5 months, getting training and stuff like that. He's my lead security guard at my property. And because he wanted to be able to qualify for VA benefits. It's still a part-time kind of a thing. He's not going to go away for 4 years. He's not signed for 4 years, but he is going to give 4 years of his life on weekends and things like that. But he can still have kind of his life. And get some money from the VA because it's not only housing he's looking for schooling. So he's trying to tap into some VA benefits. Okay, they do not impose a maximum loan amount and they're not insured. However, with a VA loan today, you can buy a house up to about $425,000 with zero down because it's called something called entitlement, part of the VA program. Now, if you're going to buy a house, $425,000, zero down, you're going to have a huge mortgage payment. No matter who you are, it's going to be a huge mortgage payment. But the VA loan lets you do that. They let you buy a house with nothing down. That's part of what people like about a VA loan. But it's a huge mortgage payment. One way or another, you're going to pay it. Conventional mortgages. Loans are not insured or guaranteed by the federal government. They're not subject to requirements like those of FHA or VA loans, but they still meet Fannie Freddie requirements to be resold. And they're conventional loans. They're still writing them under that same prescription. Private mortgage insurance insures lenders against foreclosures losses. Usually require the purchaser's down payments less than 20% of the purchase price. Anybody who buys a house with a mortgage is going to pay PMI until they get paid down to that 80% or lower. PMI is not a huge cost, but what it's doing is that while you're in debt new, it says if you default on your loan, the mortgage company is going to get paid. It doesn't help you stay in the house. It gives them mortgage. That's exactly what it is. It's mortgage insurance to make sure the mortgage company is going to get paid. But they're allowed to, by federal laws and things like that, to make sure that people that have less than 20% down or equity, that they have to buy this PMI. Once you get above that 20% equity, they have to take it off your mortgage. It's not a huge cost, but they have to take it off. Other types of mortgages. We have subprime loans. This is a loan made to a borrower who could not qualify for a loan from conventional FHA or VA lenders. We are still seeing subprime loans, but not the way we were seeing them in 2005, 6, and 7 because the guidelines have clamped down on them. But they still exist. Types of loan payments. Most of us have what's called fixed-rate mortgages. So we have a fully amortized loan, which means when we're making that payment every month, we're paying interest and principal. We also pay taxes and insurance. We're paying the whole gamut. But over that 10, 15, 20, or 30-year loan time, we're going to pay the whole thing off with equal monthly payments. Adjustable rate mortgages, they're teaser rates. You got to watch them, but they can be very good if you know how to play the game with ARM mortgages. You can get an ARM mortgage for less than you can a conventional mortgage, 1.5% lower, but they go up. They ratchet up. But you can write caps in them. You can have them so they don't go up too high. What happened in 2009 and 10 is people had ARMs. They were writing for properties they never qualified for. In the first place, they had ARMs, and all of a sudden that mortgage went up $600, $800 a month when it had an adjustment. Because people weren't capping them, they didn't know how to write them, didn't know how to use them, and then all of a sudden they couldn't afford the house. So a lot of people walked away from their houses under ARM loans. ARM's got a bad name when all this stuff happened. They work though, you just got to know what you're doing with them. Interest-only mortgages, all you're doing is paying interest. You're never going to get equity in that investment. Interest-only mortgages, I don't see a whole lot in residential. I see it a whole lot in commercial. Piggyback mortgages, reverse mortgages, home equity. I mean, there's all kinds of ways we can skin this cat. When I talk about a reverse mortgage to my mother-in-law, she looks at me like I am the devil incarnate. And I've told her, I said, if there was ever a need, if you all didn't have enough money, we could reverse mortgage your house. She's 91. She won't qualify for a reverse mortgage right now. People that are 60 or younger qualify for a reverse mortgage because they want you to live in the house for a period of years, or 70 or younger. But they want you to live in the house for a period of years. The idea behind a reverse mortgage, you're an older person, you want to mortgage the house and bring the money back to you and give the bank equity in the house. And most people are using it for medical reasons to be able to stay in their house. But the idea is they want to stay in their house. They're not trying to move to a retirement home. Reverse mortgage doesn't work if you're not going to stay in the house. It only works if you stay in the house. But what happens with a reverse mortgage is you get cash. You can cash in the whole thing all at once, or you can get money payments over time, like an annuity. And then when you die, whatever is given to you is what's reserved in that house. So when the house gets resold, the mortgage company gets that piece back, and then anything left over can go back to the estate. It's not like because you signed a reverse mortgage, you're giving it all up. It's only the amount of money that came back to you. Now, live long enough, you do the reverse mortgage, yeah, the bank can own the whole dang thing. It just depends on how much money is pulled out, how you're doing it.
Well, there's no cap, there's no like 80%.
No.
What about like terms? Like what about like it caps at 20 years or?
Well, and again, if you're going to do a reverse mortgage, there's a lot of offers out there. You have to study what you're getting into, know how you're doing it. But most reverse mortgages are for people that are trying to live in their house. They have medical needs. So they're using the money to be able to have medical care to come in. It's not people that just want to go live a fun life. You know, usually it's done because of medical needs or monetary needs. Home equity loans, again, you've paid the mortgage down, all of a sudden you got money. It's cheaper to use a home equity loan than it is to borrow the money outright on a credit card or some other means. People do buy cars, send their kids to school, take vacations, do all kinds of things with home and home improvements, do all kinds of things with home equity loans that may not even be part of the house. There's no requirements as it has to be. Other types of loan payments. We have sale leasebacks. Okay, you can do a sale leaseback. I had a guy that used to buy a lot of houses from me in the trust department. He was an attorney, and he did sale leasebacks. He worked with people that didn't qualify for mortgages for one reason or another, and he would make them pay a $2,000 or $3,000 deposit down. He'd do a sale leaseback. They'd live in the house for 3 years, and while they lived in the house, they would earn so much money every month toward the down payment, and eventually they could buy the house. He had great tenants, because his tenants took care of the house like they were going to own it. And they were vested. They were vested in and interested in owning the house. And if they defaulted, he got the $2,000 or $3,000 down plus whatever rent that they had paid for the years they were there, and then to walk away like it was a lease. So it worked out pretty good for him. But it works. But you got to watch what you do with sale leasebacks, especially in Ohio. You can only make so much of the rent count toward the purchase price. If it's too much, it becomes not a sale leaseback. It becomes it's a transaction, it's a mortgage on time. It's a land contract. It's not a sale leaseback anymore.
When is the sale price of the home agreed upon? At the beginning?
At the beginning. At the beginning. Yeah, they know exactly what they're going to buy it for, what's going to qualify for, and how much of the money is going to go toward that down payment. Yep. You can do wraparound mortgages, where you can do mortgage for more than one property or other loans. You can take subject to a mortgage. Buyer can take title of the property but is not personally liable for the payment of the mortgage debt. Interesting way of doing it. And you can assume existing mortgage. Again, purchaser agrees to become personally liable for an existing mortgage. But a lot of the banks don't allow mortgage assumptions anymore. That's that due on sale clause. It means mortgage assumption is not going to happen. Deeds of trust. Similar to a mortgage but involves 3 parties. Lender is called a beneficiary. The borrower property owner is called a trustor. The trustor conveys title to a third party known as the trustee. we don't see a lot of deeds of trust in the Cincinnati market. Deed of trust is held by the trustee for the beneficiary's benefit until the underlying obligation is paid in full. The most similar thing to a deed of trust that we see in our market is a land contract, buying a house on a land contract. We have regulations of home mortgage lending. Why? We need consumerism to protect consumers. It's the biggest investment most of them are going to buy. So we have different things involved. We have the Equal Credit Opportunity Act 1974. You'll need to know a little bit about this for your test. Unlawful for any lender to discriminate with respect to any aspect of lending transaction on the basis of race, color, religion, national origin, sex, marital status, or age. What else does that Equal Credit Opportunity Act sound like to you? When I just told you all those little things.
Freedom of,
Fair housing. Fair housing. So, Equal Credit Opportunity Act mirrors fair housing in what it allows to happen. But you cannot get a job because of equal credit opportunity. I mean, because your credit score, people are looking at your credit score when they're hiring you today. Your credit score is how your auto insurance is rated today. They want to look at your credit scores and say, oh, and here's the reason they do this, and I worked at an insurance company when all this stuff came into effect. People that have a high credit score, if they get involved in an accident and they have a $500 deductible, they probably won't even tell you until they've hit $1,000. They'll just pay for it and eat it themselves because they have money and they don't want to infringe on or have a negative impact on their insurance, because most insurance companies, once you make a claim, you're going to get raised in price. People that have poor credit scores, when they hit a $501 accident, they're going to the insurance company for help because they don't have a lot of extra money. So credit scoring, the better your credit score, the less likely you're going to come back to the insurance company for help when you have an accident. Even though you're buying insurance just for that, that's what happens. Truth in Lending Act requires disclosures to consumers about terms and costs of the loans. When you go into the closing and you buy a $130,000, $140,000 house and you pay 30 years worth of a mortgage, all of a sudden that house is a $400,000 home. And you're going to go, oh my God, what did I just do? When you look at paying on it for the full 30 years. Most people don't live in a house for 30 years. Most people live in a house 7 to 10 years. So the idea is you're not going to pay that on that anyway, but the idea is you're getting equity. You're seeing an increase in your property value so that you can use that to help you buy up bigger, trade up to something better. But the Truth in Lending Act wants to give full disclosure on what is it you're really buying, what's happening with the transaction. Freaks a lot of people out because it's big dollars. Community Reinvestment Act requires all federally supervised financial institutions to disclose their lending data in their front lobbies and elsewhere. There's also something called CRA where our banks and our major companies, Western, Southern, things like that, are going into impoverished areas and they're using money to help develop real estate. They're giving loans, they're building housing, they're building up Section 8 apartments and doing stuff like that through their CRA activities because they're getting pressure to come give back to the community, and that's what CRA is doing. Dodd-Frank Wall Street Reform, Consumer Protection, federal statute covers the reform of financial institutions. This whole thing, Dodd-Frank, they're looking at trying to make it less and less with the Republican Party today. They're trying to make it have less impact so that things can go back to some of the way they used to be. And there needs to be a look at how they're doing this. There's pros and cons on both sides of it. And you can get really mired in the whole thing about how they're trying to change this. But change happens. It's a matter of whether it's good change or bad change. Are you the consumer or are you the bank? What are you looking for? Which end are you going to profit from? Where are you coming from? What's going to help you? Construction loans. It's a loan that provides financing to pay for the cost of developing, constructing, improvement on real estate property. You get a loan commitment, you get a loan agreement, and then you have disbursement of loan proceeds. You're going to do this when you're building a new house, and you'll do it when you're doing commercial real estate. But otherwise, we're not messing with construction loans when you're buying a house, unless you're going to do major remodeling. And typically that's going to be part of the mortgage or a second mortgage. It's not going to typically be a construction loan. Installment land sale contracts. Seller provides the financing to the buyer, retains title until the final payment is received. Again, that trustee piece. Risk to the buyer, a long period of time between the contract's execution and the time the seller delivers the deed. You can enter into a land installment contract for 10, 15, 20, 30 years. You never know what's going to happen. It's not guaranteed the way it is with a bank when you do a land installment contract. It helps sellers sell their property, but for the buyer, they're going in very trusting of the seller that everything's going to stay good and stay fine. The advantage is the seller, they don't have to pursue foreclosure proceedings. And that's what it truly is. They don't have to go through a full foreclosure. They just put you in default and they take the property back. And that is it. Okay, so again, very quick synopsis of some of the stuff you're going to learn about. Any questions? All right.